Happy New Year. This is John Giordani, the Chief Investment Officer of Planning Solutions Group. Let's jump right in and talk about the markets. Now, I hate to wish time away, but I'm glad to say good riddance to 2018 as it was darn frustrating. Looking back, after a fantastic 2017 with record low volatility and above average returns for most asset classes, everything pretty much went straight up. Investors entered 2018 expecting more of the same. Now think back to this time last year. If I told you that corporate earnings were going to rise over 25% in 2018, yet to put all of your money into cash, you would have put me in the loony bin. Yet Mr. Market did everything it could to frustrate investors. Every major asset class was down. Stocks, bonds, real estate, commodities. The list goes on and on. Pretty unbelievable. And cash was the top performing asset class. Diversified portfolios were down mid to high single digits, and U.S. stocks lost more money than they have in a decade. Now, we haven't seen a year with so many asset classes down in price in 117 years. So what happened, and what does it mean going forward? After the great 2017, investors were overly complacent and not prepared for any bad news. Now, I hate to point fingers, but most of the haze overhanging markets can be attributed to our politician friends down in D.C. The biggest tax Washington can impose is uncertainty, and they're doing a great job at it. Check out the quote from December from the head of FedEx. As one of the largest shipping companies, they're on the front lines of the global economy. And we spent a lot of time last year talking about the list of items listed here and touch on some of them again today. With no consistent message regarding the ongoing trade war with China, the dysfunction in D.C., including the government shutdown, a Federal Reserve that continued to take away the punch bowl, it's not surprising to see the current economy and corporate earnings begin to slow down. And investors responded by rushing for the exits, with stocks around the world entering a bear market. Now, before we move on to talk about the fundamentals, I want to take a couple of minutes to address the number one inquiry we're getting hit with right now. And it goes something like this. John, I'm nervous as stocks are in a bear market, and I've been hearing now is a good time to get out of the markets and move to cash. I can then reinvest when things settle down and it feels better. So let's break this question down. First, let's talk about bear markets. They're not fun, but they are an inevitable part of the investment cycle. And this is the second one in a little over 4 years. Listed here are the 11 bear markets where global stocks experienced significant losses going back to 1970. So that's one on average every 4 years. And the average loss is around 25%, which I just highlighted in red. Now, to avoid a bear market, an investor really has to do two things right. First, know when to get out, and just as important, when do you get back in? And let's highlight the current bear market. How many foresaw the events in the fourth quarter that led to this 25% correction? Things felt pretty darn good up until September 30th, so my guess is not many. Okay, but that's the past. What about now? Well, stocks are down and fear has overtaken the market, but why not wait it out in cash until things settle down and it feels a little bit better? Looking at the data, this approach has been a loser. Yes, the stock market can go down further, but look at the column highlighted in green. This is the performance of stocks 1 year after they have already lost 20%. Notice 1 year out, on average, stocks are materially higher. So it's probably too late to sell, even though it still feels pretty terrible. And the other two columns look at stocks 3 and 5 years performance after the bear market. You can review this data on your own. Now the question is, so when do you get back in? And I've never found anyone who can consistently get both parts right, knowing when to get out and then when to get back in. And in fact, Goldman Sachs Asset Management did a study, and if you just miss the bottom by 1 month, you miss 22% of the total return for stocks during the next cycle. So two big takeaways. Markets don't settle down. They settle up. Secondly, the greater, longer-term cost to your portfolio is being out of the market. Time in the market has paid handsomely. Market timing has not. Unfortunately, it's human nature to want to get out of tough markets, and we're genetically programmed to avoid danger. And if this trade is acted on, it's going to probably negatively impact the long-term health of your portfolio. Now let's switch gears to what I believe continues to be the most important overhang for the economy and markets, and that's the trade war with China. Tariffs are a tax. The potential effects if all announced tariffs and retaliations are enacted are quite significant. A study by Impact Econ shows a $365 billion hit to the U.S. economy and up to 2.7 million in job losses. But what can't be measured is the impact on business executives' optimism and how this translates into their decisions on capital spending. Now, I have talked with several strategists who spend a lot of time overseas, and their commentary is that this uncertainty is having a much bigger impact outside the U.S. right now. There are anecdotal stories of decisions being delayed, and there has been a pullback in manufacturing. Recall, international economies are generally much more exposed to trade than we are here in the U.S. Now, our base case assumes we escape a recession, but the Trump administration must reduce the uncertainty on tariffs. It's very damaging the longer this goes on. To allow global economic growth slowdown to reverse, it's critical for progress to be made on this issue. Hopefully the stock market swoon in December sent the current administration a loud and clear message. In prior communications, we've highlighted the risk of computers gone mad. Now, what do I mean by this? Bottom line, when volatility rears its ugly head, the sell-offs are likely to be gut-wrenching and happen quickly. This is due to the dominance of computer-based and momentum strategies. The Wall Street Journal wrote a very good article, which I've summarized the main points here. The days of investors sitting around the table and discussing the fundamentals of a company, like its growth, market position, the management team, the valuation, they no longer matter as much. Now, algorithms and trading strategies account for a majority of stock market volume. Many use momentum as a key input, which means buy those stocks that have rising prices. And guess what? When the momentum reverses or the signal to exit flashes, these computers all trigger at once and everyone heads for the door at the same time. Liquidity evaporates and the knee-jerk move down is amplified. Just be aware of this issue, but this should not change your approach as a long-term investor. So far, a pretty Debbie Downer presentation. But it's not all bad news. Yes, growth is slowing, but it's still up and to the right, and there are many positives we see in the global economy. Don't forget about 2017's corporate tax reform. Company coffers continue to fill up, and that's good news for shareholders in the form of higher dividends and stock buybacks. Mergers and acquisitions activity should also continue. This should help support stock market prices. The Federal Reserve has been raising rates for over 3 years. The bulk of these hikes are behind us, and I think the Fed got the message in December to be very patient as it proceeds. Lastly, the boom in corporate earnings combined with the stock market sell-off has valuations looking much more attractive than a year ago. Putting this all together, where does this leave us with portfolio strategy? Remain diversified. This is not a time to be a hero, nor is it a time to head for cash. Given the risks, having balance is likely the best way forward. While markets have bounced recently, don't be surprised for a retest near the lows, nor volatility to remain above average. Having some defense always helps as well. Several of our tactical strategies had lower risk and raised cash equivalents to north of 30% as we headed into the end of September. That's because last year they were having a tough time finding good value. They used the fourth quarter sell-off to increase equity exposure by 5 to 10%. In addition, we were proactive by adding to areas that we felt were oversold and are being compensated there to take risk. These include small cap financials, emerging market stocks, and preferred income securities. We also want to focus on high quality companies and avoid speculative investments. It's late in the economic cycle, and we want companies with staying power if we do hit a recession. Overseas stocks, especially those in emerging markets, are undervalued versus historical measures. We also believe the demographics and spending boom that should come from certain emerging market countries are a long-term secular tailwind. Lastly, for fixed income, we want to emphasize flexible strategies that can help navigate a tough interest rate environment. We hope you enjoyed the current market update. May the new year bring you good health and prosperity. If you have any questions, do not hesitate to contact us. You may also access more information, including timely articles and account information, by visiting our homepage. Please watch for another market update later this year. Thank you.